All right. I think that will conclude that segment. Brett, you have you're looking at the Trump tariffs, the impact they have on the general economy, and what you could see going in, at least in the near term, going forward.
Yeah, so I really want to do this just because there's been a few things that have come out. We've had GDP come out, we have some like ports data, stuff like that. And it's really just to see how the economy is really reacting as a whole to the Trump tariffs. Because you're going to see certain effects come in and out over the next, especially month. And people are going to be freaking out. You're going to have headline numbers. You're going to have great results the next month because they're going to have these fluctuations that just reverberate through the economy. So I really just want to go through what we can really see in the economy right now and what may occur in the near future. So last week we got advanced US Q1 2025 GDP numbers, and GDP for the country fell by 0.3%. This was driven by actually a massive surge in imports as companies really tried to front run tariffs. The chart I have up right now, you can just see the bar for imports is just huge. It outweighs everything out by a significant amount. Imports grew by 5% year over year. So GDP just, if you're taking the expenditure side, which is how you normally calculate GDP, it's consumer spending plus investment, or consumption, I should say, which is consumer spending, investment plus government spending plus net exports, which is just exports minus imports. So the much higher imports, it lowers GDP. It's a negative impact, which is why you just get that contractionary effect in the overall GDP. If you are just seeing GDP fell by this, it's the rest of the economy was doing fine, and actually imports really brought it down. And this is what I mean by you're starting to see some of these effects just trickle through the American economy, even in just the numbers. And as well as I will say is this impact is actually only temporary. As imports flow into companies' inventory and then they're sold off, that will appear in consumption, which will appear in future GDP, which will prop up future GDP to a degree, assuming you can sell the inventory you brought in. As well, I will mention here, these are advanced GDP numbers, which do get revised to first preliminary numbers and then final numbers in the next couple of months. And during times of stress and just uncertainty, the revisions can be greater when you look at recessions. Normally, the revisions are greater, especially on the downside. So whether or not we do see that happen here, that's the question. If we do see future revisions, because as I think Aaron had a couple weeks ago, he showed the Atlanta Fed GDP now, which we can look at now. Just this is for Q2, but at the time it was something like 2.5% negative for Q1, and obviously that wasn't the case. But Atlanta Fed GDP is a bit different as well because they're looking at more active. But the point is, GDP gets revised as more information comes in. So if you look at the Q2 GDP, it's now expected growth of 1.1%. This is a continuation of that general slowdown we have been seeing over the past really year or so, but it's just not the same degree as that headline minus 0.3% number we saw in Q1, because we're not having those massive surge of imports anymore now that tariffs have came in. The US did have some early impact tariffs in March against steel, aluminum, and auto, but it wasn't until the so-called Liberation Day, which we really saw broad tariffs implemented, and that really hurt the entire, or really surged the degree of tariffs as a whole. And then we saw just really the following week, the tit for tat, and then Chinese tariffs are up at 145%. So likely moving into the next quarter, we're going to see actually the opposite impact from the import-export dynamics. Since we saw all that front running of tariffs, imports being heightened, we'd likely see it lower. Even if tariffs just disappeared, you're going to have heightened inventory right now, which means in coming quarters, you would naturally have less imports, even if all the tariffs went away. But coupled with that increased tariffs, you're going to have significantly lower demand, particularly for Chinese products and goods, as the costs have surged with the 145% tariffs. You might not see, with tariffs, you have to remember, it might not be the entire product. For some things, it might be the finished product, which you probably see 145% pass through. But in some cases, it might just be a component. It might be 1, 2, 3% of a company's cost, and they might take that on. They might raise their products by only a few percent to offset the tariffs. It depends on the product and the end market, of course. So it's not 145% across the board by any means. Like, I've seen some people misrepresent the imports. tariffs. It's not to that degree. Further, though, the U.S. has removed the de minimis exempted packages, which declared under, if you had a package under $800 of declared value, which I will tell you now, a significant amount of importers did just lie on their custom forms as well. So then they didn't have to pay any duty. So companies like Temu, Shein, those Chinese low-cost companies took full advantage of this. And in the chart I have up, you can actually see a massive surge in low-value packages over the past decade. The small packages will now be subject to a 120% fee, or a flat rate of $100, which they're actually going to further increase to $200 flat rate on June 1st. And I just want to really contrast that in comparison to just U.S. imports at total value over the past decade. You can see it's really been plateaued year to year. There's some volatility, but the overall dollar value of imports is more or less plateaued. Contrast just to the surge in volume in low valued packages. This change alone, excluding all the tariffs and everything else, could have structural change to the U.S.-China trade relations, as you just have really had such an emphasis on these low dollar packages. Overall, we will see a drop in demand for Chinese products into the US. JP Morgan is expecting a 75 to 80% drop in shipping from China into the US in the second half of the year. So that is a massive drop in imports in the second half of the year. And it will have really effects across not just the US, but the world economy, as you do have those effects really start to spread out past there once you have the run-on effect of various economic impacts. And the one thing we can start to look at is ports, because they can be really seen as a forward-looking data point, and just how they will result in the impact on the U.S. and the drop in shipping will have on the U.S. So looking at the largest port in the U.S., LA and Long Beach, shipping takes about 2 to 3 weeks to travel from China to the west coast of the U.S. So we've really had that delay. You can think about it, we're about 3 weeks out from the really big uptick in the Chinese tariffs. So now we're just starting to see this week the actual impact of tariffs at U.S. ports. Because once it's on the boat, or once it's declared to go on the boat, I can't remember which, I think it's once it's declared to, then you're locked in out of that tariff. So if you're in that 1 day period where they're at 45%, by the time it got to the US, which would be around now, you're only paying 45%, not 145%. So we're just seeing that impact just now hitting US ports. You have a drop of 35% year over year at the port. And just to give you an idea, Chinese imports for the port of LA and Long Beach is about 45% of the activity at the port. Was it all of it? No. But a lot of it, yes. If you compare that to the prior week, that's a 16% drop week over week, as you obviously do have fluctuations on a weekly basis as well as a yearly basis. Next week is expected to fall 11% year over year, with the following week rising 65% year over year, which might be, why is it rising? Well, that's because likely many of those shipments are actually going to be canceled, or the port is going to be skipped, otherwise known as blank sailing. Assuming no shifts in tariffs or the de minimis rules, this likely is going to not create an empty port like I've seen some YouTube videos and social media posts claimed, but it is a clear slowdown of port activity. You're probably going to see, like I was saying, a drop in that 65% increase is probably going to end up going negative as well, in my opinion. But we'll have to see how that works out. Because even when I looked last week for the week 20, the May 11th to 17th, that number was actually higher as well. So we'll see how that ends up in the next week or so. So what does this actually mean? In the coming days and weeks, they'll likely actually start to see a real impact in the U.S. economy, as there'll be a slowdown in trucking and port worker hours as imports fall. The LA port is significantly automated, so the worker hours is a lesser degree than it used to be. But really what you're going to see is trucking will likely be impacted significantly. As imports fall, fewer products are needing to be moved across the country. This will just overall drop the degree of trucking across the country. This will result in heightened unemployment within the industry and weaker fundamentals for companies within the industry. So if you are invested in a trucking company, Q2 will probably be quite a bit weaker than Q1. That's not unexpected. this will be this really what I would call the start of the real world impact of tariffs. We've seen the financial markets react and various commodities change. We've seen gold skyrocket, but we're starting to see an impact on what will likely be employment in the next month or so. Next, as the built up inventory gets moved through the US, consumers will start to see either higher price or fewer products on the shelves, likely a very big combination. For instance, instead of like 10 types of blue shirts, you might only see 5 types and at a higher price as they're manufactured in the US or Cambodia or Vietnam right now, and not in China. And this will start to happen likely over the next few weeks as the shipments move throughout the US into later May, early June, sometime in there around that, depending on the inventory on hand and the degree of reliance on imports for the industry. Larger retailers might be able to absorb the cost for a bit, but then they'll end up passing them through eventually. But small businesses in particular, as they can't absorb the costs as easily, they'll probably likely look to pass on costs at a quicker rate. But for some companies, they may have months of inventory on hand, allowing them to shift their supply chains out of China into whatever lower tariff jurisdictions. But obviously, we have a bit of uncertainty there, to say the least. But generally, just as a whole, this will put upward pressure on inflation within the US in the second quarter. And as far as financial markets go, as they digest these new factors and as we progress through all the uncertainty and how the actual real economy adjusts, we'll likely see an uptick in volatility, in my opinion. We've seen a period of reprieve with the broad market recovery. But if there is no change of pace and the policies remain erratic, volatility will likely come back. We've had a good few weeks. If you do start to see bad news hitting the headlines again, you're probably have volatility. That leads us to really the next big question is whether we actually see a pullback on tariffs after this 90-day pause on really every country but the US but China with the US. So we saw the 90-day pause after Trump's initial board of tariffs on the left there. And he pulled back to effectively every country but China to 10%. And that will run out on July 8th if you're actually going by 90 days. If we don't have trade deals being announced by then, the real world impacts will likely be exacerbated. People will start to panic again. We saw that the following week after those tariffs were announced, people and financial markets really got scared. You saw VIX spike right up. You saw volatility really increase. But of course, with Trump, things can shift at a moment's notice. Trump just announced a 100% tariff on foreign films for national security purposes. I'm not sure how national security comes in there. I think Trump just might want to be in another Home Alone, but that's just my speculation. That's what he's aiming for. But the general instability just exacerbates these negative impacts of tariffs, as you really can have these whiplash effects. Because right now, even if tariffs are removed, why I'm focused on ports is you are still going to be really missing at this point 3 weeks of shipments. That inventory is not coming to the US. It has gone somewhere else or stayed in China. You will have that 3 week gap. Yes, there is a heightened level of inventory right now, but the longer this goes on, the more of a really whiplash effect we'll see in supply chains. And we can see something like COVID, where we have this period of oversupply, undersupply, oversupply, undersupply, and then you have people panicking buying toilet paper. That isn't shipped from China. That's mostly US production for the US, but I would not be exactly surprised if we did see another run on toilet paper. But companies and financial markets really like a clear policy, and we just don't have that here. It doesn't matter if it's even negative, preferably positive, but even if it's negative, financial markets would rather have a clear line of sight, and that's just not something that has happened here. And what one possibility, which I'll end my segment on, is just more of an open question is, do we just see tariff pauses? Do we see the end of the 90 days and then he goes, oh, it's 180 days now? Do we just see him just slowly push this out? Because that's what I'm starting to lean towards. Or do we actually see a set policy going forward? That is really the question which I'll be looking towards at this time.
Yeah, very interesting. And I do like the picture from Home Alone there. That is a great picture.
One thing that I'd like to
It's
bring up
classic.
too is, we spoke with we spoke with a company last week, the CEO, and he ended up getting a contract from China, and they do manufacturing in the U.S. and it's forcing him to make the decision of do some contract manufacturing in Europe, for example, or actually buying the capital equipment in Europe and setting it up himself, to basically do the manufacturing there rather than in the US. So
it's severe irony, right?
yeah.
Because like the policy, the tariffs were put in place to increase U.S. manufacturing, and this is a company. It's a small part of the business, but they're manufacturing in the U.S. a material that is then sold to China. And because of the reciprocal, the tariffs that were put on by China from U.S. goods going in, now that order, it was $1 million order, not massive for the business, but not nothing.
Mhm.
It is now canceled in the near term, kind of on hold, but canceled. And to get around that, the business that was manufacturing for years in the US now is looking to move to Europe, manufacture there, and sell the same items to China because they will get around that tariff. So the exact opposite is actually occurring. Again, this is anecdotal in one
Yeah.
business. It's a great point that Brennan brings up, but it's ironically the exact opposite of the intended policy is occurring potentially with that company.
Mhm.
Yeah, it really as a whole just makes capital allocation for a business impossible to do. And that's what I mean with companies can deal with negative or positive impacts. It's hard to deal with uncertainty.
Yeah, and part of it there is this company, this CEO is looking at it and saying it's more stable to manufacture likely out of Europe because we have a low degree of likelihood that you're going to get that type of tariff put on those European goods going into China. So they may make, it's still in the decision making process, but it looks like it could go forward. They may make that decision to move manufacturing from the US, not bring more in so they can ship to China without that tariff.
Yeah.
Yeah. It's unintended consequences, but I mean, you had to think that if you're going to put those aggressive tariffs on China, China is going to do something back on your goods that are going towards China. And now that they have, and you're seen as being a volatile nation tariff wise, do people consider moving out and moving to another jurisdiction and shipping to China?
Yeah.
So
Yeah, one of Trump's advisor, Bessent, actually came today saying out today something along the lines of can still invest in the U.S. It's still the great premier place to invest in the world. Where
yeah.
other analysts are saying that U.S. brand is tarnished, and that's
Yeah.
really the
It's all
trade-off.
about certainty, and the power of the dollar has been about stability, and you rock that. And like this is again an unintended consequence, but we're hearing directly from a CEO, not the biggest company in the world, but you're talking about one order from them that is $1 million. They're employing people to manufacture in the U.S. and now considering moving that because China has a tariff. And of course, the administration in the U.S. I guess could say, well, remove that tariff, and then it won't. Well, I mean, then they're going to say remove the tariffs on us, like it. And that's the uncertainty, and they're not getting that uncertainty if they manufacture that same product in Europe.
Yeah.
So it is interesting. It is interesting
Yeah.
when you get that level of commentary from a business that's dealing with the day to day of these policies, and they're making a move that is counter to what
Donnie.
at least is stated to be intended,
Yeah.
right? The stated intent.